and welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Obviously, as a poster child for the AI boom, not to mention the best performer within the Magnificent Seven, I think it's important. We know the bar is set high, so I think an extrapolation problem could develop, but whether that starts tomorrow is hard to say.
The quarter was a little bit better than expected. The expectations were not very high. As you mentioned, the same-store sales numbers were still negative, but they weren't quite as negative as expected. It was against a pretty easy comparison because the first quarter of last year was not particularly strong. So I think people were a little bit relieved that the quarter was better than expected.
Higher rates, less home activity, that home price appreciation that we're seeing get better. Maybe that turns back for the worse if turnover slows because of rates. So the stocks and the businesses are definitely driven by rates. Higher rates, higher for longer is not a good scenario for these guys. So they will react positively, again, both the sales and the stock, if and when rates start to come down.
We've got 1 hour to go until the market close, and we're taking a look at the major averages here. Not much change today. It feels like another waiting game kind of day here, with the Dow almost flatlined here, up just 24 points right now. Remember, any gain, though, will be a record when we're looking at some of the averages here today. The S&P up 0.1%. The Nasdaq, it's the case for them, up almost 0.1% here. And looking across asset classes, there are some interesting moves here today. We continue to see a little bit of downward pressure on yields here, which continues to be a little bit supportive for stocks, 4.41% there on the 10-year. We continue to watch what's going on in crypto as well. Another 1.5% upside for Bitcoin, which went above 70,000, and we continue to watch Ethereum very closely as well. We're going to have more details on that later in the show. Looking at some of the sector action that we are watching today, industrials and energy weak, but utilities strong again, as are the financials. And speaking of utilities, by the way, because we've been talking about this a lot lately, utilities now the best performing group on the year. They have been for a little bit here, 14.7%. And as we do the drumbeat to Nvidia after the close tomorrow, its earnings, there's now been this narrative that has bound up power companies, utilities, with AI because of the immense power needs that are going to be necessary going into the out years as we do more data center and compute capacity. Takes a lot of energy, Josh.
That's right, Julie. So stocks searching for direction here as investors hold steady, following more higher for longer commentary from the Federal Reserve members. Fed Governor Christopher Waller said today he favors holding interest rates steady for longer and needs to see several more months of favorable inflation data before lowering rates. First guest today still sees a path of Fed to get the 3 projected cuts in for this year. Let's now welcome in Kevin Mon, Hennian and Walsh CIO. Kevin, good to see you.
Good to see you as well, Josh.
So let's start there, Kevin. So stocks relatively muted today, right? Which makes sense. You got Nvidia earnings on deck. But we did have more Fed speak. Governor Christopher Waller made some headlines. Effectively, Kevin saying, listen, I got to see some more, effectively several more good inflation prints before I start cutting. So it was more that higher for longer mantra. What did you make of it?
Yes, I think the Fed needs to be careful because if they keep rates too high for too long, they risk their own forecasted economic slowdown moving into a recessionary period. If you recall, just in March, the last dot plot chart suggested 3 rate cuts this year, 3 rate cuts next year, and 3 rate cuts in 2026. Add that all up, you got rates about 225 basis points lower before the Fed gets back down to their inflation target of 2%. So why would they be cutting interest rates if their inflation target isn't being met? Because they're more concerned with the recession than they are with inflation staying above 2%. Of course, they want to see more positive progress on the inflation front, but they're more concerned with that economy slowing too much and dipping into recessionary territory.
Is that to give the dots a little too much credence, though? You know what I mean? I mean, even Jay Powell seems uncomfortable with the dots at best, right? So there's what the dots say, there's what the market thinks, and then there's reality of what's actually going to happen. And nobody actually knows the reality of what's going to happen.
None of us have a crystal ball, and Chair Powell doesn't have a crystal ball.
No, definitely not. So, when you're looking at, if indeed you think that they're really focused on the possibility of recession, what are some of the signs you're looking for that might be, you mentioned a couple of them, what are you watching most closely to see if some of that is coming to fruition?
Sure. So I looked at first quarter GDP growth slowing to 1.6%, well below expectation. Then I look at the most recent consumer sentiment survey, slowing to its lowest level since July of 2022. We saw unemployment tick higher to 3.9%. And we're also seeing an over-leveraged consumer now starting to slow down the pace of spending. If they shift to servicing all of their outstanding debt at higher interest rates as opposed to spending, the economy will slower.
Kevin, let me ask you another question on this. So I look at commodities, right? We've been talking about this on this show. Just the moves we are seeing.
Yes.
Copper, aluminum, silver, gold. How does the Fed possibly cut, Kevin, in the face of those kind of moves? I mean, at the very least, do you think it kind of it complicates Jay Powell's job?
I think it goes back to the early 70s, right? The last time the Federal Reserve cut interest rates before getting back to their 2% target. Arthur Burns was the chairperson at that time. When he cut rates, what happened? Inflation came roaring back, hit double-digit levels. Then Paul Volcker stepped in and raised short-term interest rates, Josh, to 20%. We think 5.25% is restrictive. He raised it to 20%, killed inflation, but it also brought on a pretty severe recession. I think that's what they're trying to navigate right now, and their job isn't easy. But I do believe that they want to cut interest rates. They just need more data to validate that first rate cut. But when the first one comes, I would anticipate a multi-year, slow, gradual interest rate reduction path.
Okay, so what does all of this mean for stocks? I mean, we have had bear after bear on Wall Street saying, I was wrong. Mike Wilson of Morgan Stanley was the latest. JP Morgan's Kalanovich is the last one who remains somewhat bearish. So, but it seems like no matter what these people's outlooks are, stocks are going to go up.
Yeah, but I do think the market has got a little bit ahead of itself thus far this year, pricing in the perfect execution of a soft landing by the Federal Reserve. And we're clearly not there yet. So each time a successive FOMC meeting goes where they don't cut interest rates, you could see some more short-term bouts of volatility. But once that first interest rate cut does occur, then I think you'll see a tailwind for both stocks and bonds beyond just Nvidia. All the talk this week is about Nvidia, and I do believe the stock market has been riding in the wave of Nvidia for the better part of the last year, and that wave's about to get bigger tomorrow.
Yeah, so that's interesting. I was going to go there, Ken. I wanted your take on Nvidia on deck, earnings after the bell tomorrow. I want to, just kind of walk us through what you expect there, and how important is this for the market?
It's very important. Expectations are for earnings per share of about $5.22. If that comes through, that represents a 406% year-over-year increase. And I do believe that there's going to be more talk by NVIDIA about building out their own data centers. Data centers is often a very forgotten part of the AI ecosystem. You mentioned in your earlier segment the tremendous electricity demand coming from data centers. It's estimated by 2030, data centers alone will consume about 10% of our country's electricity. That's tremendous, right? But there's other companies that are stepping in to help address that very type of need. A company like Vertiv, which we like in the industrial sector. What do? They supply the electricity, the infrastructure, and the cooling solutions to data centers. Or how about Arista Networks? They supply the Ethernet switches that power and make data centers work efficiently. There's so many other opportunities beyond NVIDIA out there, but everyone's focused on NVIDIA, and rightly so.
Is it an or an and?
It's an and. It's clearly an and. I don't think you abandon NVIDIA by any means. They could be the ultimate winner of the AI race, but there's so many more opportunities
and
out
just
there.
a specific question to NVIDIA, because there was a report today in the Financial Times that Amazon was sort of putting on pause its orders with NVIDIA. Yeah. It's waiting for Blackwell to come out. That's the next generation of NVIDIA chips. And this has been a concern among some investors and analysts that because clients were saying, well, we've got the Hopper chip that's here, but we want the better one that's coming out later this year, so we're not going to order any more Hopper. We're going to wait. Is that a concern for NVIDIA? Is it going to cause some hiccups?
Or does it provide for more backloaded positive earnings growth later in the year? Blackwell is promising 25 times less cost and 25 times less electricity usage. That's powerful. Plus, Nvidia is trying to go beyond just chips and offer the whole packaged AI solution, plus getting more CapEx spending in data centers. They're not stopping here.
Well,
they're only going to continue to grow.
And Blackwell's also going to be more expensive, by the way.
It's going to be more expensive, but it's also going to
The move it's made, though, Kevin, into this print is a headline grabber. I mean, it's up 90% already this year. I mean, expectations are just red hot.
I mean, clearly it's setting up for a potential disappointment, but I don't see that disappointment coming. I think they're going to guide forward, looking ahead to projected Blackwell sales with the deliveries anticipated for the second half of this year. And then once they start focusing now on data center expenditures and growing in that market as well, I think it could move even higher, which is tough for me to say because I'm a value-oriented investor and they're trading at pretty rich multiples right now. But if you factor in the earnings expectations, not too expensive.
Always good to see you, Kevin.
You
Thanks
as well,
for coming in.
Jules. My pleasure.
Appreciate it.
Thanks, Josh.
All right, sticking with tech, it's day one of the Microsoft Build event. Our Dan Howley is in Washington at that conference, in Washington State, that is. Dan, what can you tell us about the event so far?
Yeah, Julie, I'm here in Seattle at the Seattle Convention Center. We had Satya Nadella take the stage, as well as Kevin Scott and special guest Sam Altman of OpenAI. Essentially, what the big to-do here is AI. I know you guys are just talking about NVIDIA. It's trickling everywhere. And Microsoft, obviously, with their team up with OpenAI being a huge beneficiary of it. The big deal here is them getting GPT-4o into their Azure suite, which means that companies will be able to build their own kind of co-pilots, which are essentially AI assistants using GPT-4o. And so that's a huge deal for Microsoft to be able to offer to its customers. In addition to that, they talked about how they're building out GitHub as well, and they're going to continue to offer various co-pilots across its different offerings. But really, I think the main deal here is that GPT-4o is going to be available right away for Azure, and that's something that Microsoft really does have as a big benefit over the likes of someone like Google or Amazon.
And Dan, so you're there right now, and Microsoft executives, they're on stage, you're talking chat, GPT-4o, giving demos. How should we expect how that technology, Dan, is going to just kind of change the way we interact with our computers?
Yeah, I think the big deal with this in particular is they call it multimodality, and really what that means is that you'll be able to use video, voice, and text. And it's the video aspect that's really kind of fundamentally different than what we've had before. There's been video offerings in the past, but the way it all comes together in this package is truly interesting. And so some of the ways that they demonstrated on stage in some pre-recorded demos, albeit, was a developer having trouble with a code. They were doing their coding, they couldn't figure something out, and so they pulled up the Copilot on their phone or powered by GPT-4o, and they said, hey, what's wrong with this code? And they used their camera to show the AI the code on their computer screen. And then it was able to say, oh, hey, why don't you try changing this aspect of the code to get the outcome that you want? And so those are the kinds of things that really start to get you thinking about what does the potential future of this technology look like? It's not just, hey, ChatGPT, make me a dumb poem or something like that. It's really a fundamental difference now when you add in the video as well as the voice. And so I think that's where a lot of companies are going to end up going. Now, obviously, the big question remains as far as hallucinations go, accuracy. That's something that they're continuing to work on. There's different technologies like RAG that they're using to cut down on hallucinations. And the more they advance, the fewer there'll be. That being said, this is still one of the most interesting technologies to come out of this. And as you were talking about NVIDIA, it's going to need to be powered in some way. And NVIDIA right now is the one that's doing it.
Indeed, they are. And we're, in case we didn't mention, they're reporting earnings after the close tomorrow. I'm not sure if we know that. Dan, thanks so much. Appreciate it. We're just getting started here on Market Domination. Coming up, Ethereum and Bitcoin are soaring amid growing optimism that Ethereum ETFs could be approved as soon as this week. We're going to speak to the CIO of Bitwise on the other side about his firm's efforts to get ETF approval. Plus, shares of Tesla riding higher after the EV maker revealed new details about its semi-truck program. We'll tell you when you might see Tesla tractor trailers on the roads later in the hour.
And at 4:30 Eastern Time, it's the latest edition of our new show, asking for a trend. I've got you covered with the latest market moving stories so you can get ahead of the themes affecting your money. Stay tuned, more market coverage after this.
The number 2 trending ticker on Yahoo Finance right now, it's one that doesn't always make an appearance, Ethereum. Fresh optimism about the Securities and Exchange Commission approving spot Ethereum ETFs ahead of the first deadline later this week. And joining us now is Bitwise Asset Management CIO Matt Hogan. Matt, it's great to see you. You guys, of course, have an application in for an Ethereum ETF. You got your spot Bitcoin ETF approved along with the others earlier this year. So I know that you're also encouraged by some other developments in Washington, which we'll get to in a second. But I do want to ask about this first and what you guys are hearing and how close you think it might be.
Absolutely. It's great to be here, Julie. This has been a big change. You know, I think last week, the betting markets on Polymarket had about a 10% odds of seeing a spot ETH approval. And now those odds are up above 80% by the end of the year. So the market is voting that this is likely. We're seeing that as issuers update their 19b4 applications. It's not a guarantee that we're going to get to approval, but it looks a lot more likely than it did last week. And you're seeing that reflected in the price and the fact that the ticker is trending there on Yahoo.
And Matt, you know, you think about Gary Gensler and how, you know, listen, Matt, he didn't want a spot Bitcoin ETF. There was a lawsuit. I mean, do you think there ultimately is going to have to be a lawsuit to see a spot Ethereum product?
You know, I thought that might be the case, but it looks like common sense might prevail. We already have Bitcoin futures ETFs, and we got a spot Bitcoin ETF. We have Ethereum futures ETFs, and now the market is pricing in the likelihood that we'll get a spot Ethereum ETF. And I think the important thing to remember is look at what the Bitcoin ETF accomplished. It dramatically lowered costs. It made it safer and more regulated to access Bitcoin. Those are wins for investors. I thought we might need a lawsuit, but I do think common sense is going to win out here. And I think that will be great if it does.
What changed, Matt? I mean, there's been some reporting here that the Securities and Exchange Commission has now sent out requests for comments or follow-up requests to some of the firms. Have you guys gotten a follow-up request from the SEC? And why do you think that they did this all of a sudden? I mean, it seems, as you said, what's reflected in the markets, pricing this in, it's changed pretty quickly.
Yeah, obviously I can't speak to our specific filing because it's live at the SEC, but you are seeing issuers update their filings. Bitwise certainly plans to be competitive in this market. I think it's a little bit what you hinted at the top of the segment, which is there has been a real sea change in Washington around crypto. We saw the first piece of comprehensive crypto or positive crypto legislation pass both houses of Congress with the SAB 121 reversal. We're seeing a coalition, a bipartisan coalition emerging around stablecoins. It looks like Washington has gotten the message that crypto is good for America and that it's popular with American voters. And I think that's trickling through into different parts of policy. I don't know that that's specifically what's driven this change around Ethereum, but I think it's hard to look at what's happening in DC and not see a change taking place in multiple areas, including in the ETF market.
I'm interested, Matt, you're talking there a lot about what's going on in the nation's capital, and with this upcoming election, I am curious to get your sense of how much you think crypto is going to be an issue. You can see Trump, of course, really positioning himself as a fan to the crypto faithful. I think it's fair to say GOP broadly has become kind of just more friendly, Matt, to the asset class. Do you see crypto, in fact, during this election becoming this kind of ideological dividing line?
Yeah, I think it's going to be an important factor. I know that sounds crazy to some people. How could something as relatively small as crypto influence something so massive as the US election? But remember that there are very close contests in many congressional races and indeed for the presidency. Handfuls of thousands of voters can really swing things. And there are a lot of people who deeply care about crypto. I think what you're trying to see is the Democratic Party move more towards the center on crypto, embrace it as part of America's future. And that's positive. So I do think it is a major factor. I think the other major factor is traditional Wall Street now wants to participate in the gold rush that is the crypto market. So I think you're seeing some lobbying forces from Wall Street move the political discussion, and you're seeing the growing political influence of crypto shape the nation's politics a little bit in those close markets. I think it's a game changer for the crypto industry. I think it's going to push us to new all-time highs.
Matt, real quickly, who's better for the crypto industry, Biden or Trump?
Look, I think crypto can thrive in any environment. I think the worst possible outcome for crypto would be a Democratic sweep of both houses of Congress and the presidency. But absent that, a mixed market either way, I think it's going to be a good 4 years for crypto.
All right, Matt, always great to have you on the show. Thanks for joining today.
Thanks for having me.
Sticking with the prospect of another spot crypto ETF, Jared Blickery is here now with a look at the lessons learned from what happened with Bitcoin. Jared.
Yes, it's easy to forget that only at the beginning of the year, we were still looking forward to those spot Bitcoin ETF approvals. And I'm going to put up a chart here of Bitcoin. This is going to be over the last year. And that rumor mill really got started last October. We didn't get the approvals until, let's say, mid-January. And we actually saw a little bit of a decline. Sell the news on that. But then we rose to record highs. And that's where we've been kind of languishing in this upper end of this trading range here. Now, with Ethereum, really interesting that this comes right now. It was only a week or two ago that President Trump himself came out as a pro-crypto candidate, and it's leading a lot of people to speculate that this reversal, this sudden reversal that we saw at the SEC with respect to the spot Ether ETFs is because the Democratic Party wants to be more competitive in crypto. So whether or not that's the case, I do want to point out, Jim Bianco has pointed out rather, and I'll echo his sentiments here, that the whole purpose of the spot Bitcoin ETF, that there was going to be this wave of boomers and people just absorbing all this Bitcoin into their 401ks. This did not happen. In fact, we see the Bitcoin ETF flows. This is as of this year, so this is year to date, largely just following the price. Bitcoin topped out right in here, and this is when it started trading in that range, and that is when the flows started decreasing. So we haven't seen the promised uptake in people's 401ks. That could happen, but nevertheless, the fact that this is now a political football is just bullish for crypto. You're probably going to see a lot of favorable statements into the election, so take that for what you will.
Jared, thanks a lot. Appreciate it. We'll continue to be on top of this. Well, checking in on some of today's other trending tickers. Let's talk about Macy's. Those shares are higher after the company topped first quarter earnings expectations and raised its full year earnings guidance. Yahoo Finance's Brooke DePalma here with some takeaways from the last quarter. As you pointed out in your write-up this morning, yes, they beat, but the expectations were quite low.
The expectations were quite low for a department store chain that is in between a turnaround strategy or a buyout bid. And so Wall Street was, and at the end of the day, somewhat impressed. Shares up now roughly 3%. But what the CFO, Macy's CFO Adrian Mitchell did tell Yahoo Finance was that in the early days of their new chapter, or their new strategy, that bold new chapter they call it, they do believe that they're getting traction. They did say that it's early days though. And what gives them confidence that this turnaround strategy is working and giving the street confidence as well is that those first 50 stores that they invested in, they saw sales uptick of 3.3%. And they're introducing new brands. Think Free People, French Connection, a more higher end brand that seems to be trending well with customers. They're also increasing staffing, visual presentation, and digital investments at those locations. Now, as far as the outlook for the company, they do expect sales to come in between a 1% drop to 1.5% lift. But CFO Adrian Mitchell once again citing that this is a difficult consumer background environment, and they continue to believe that there's a lot of uncertainty and inflation continues to remain stubborn, perhaps pushing off customers from coming in more. But luxury brands continues to do well for them. They're seeing a lot more ground there, they believe. Blue Mercury saw comps up 4.3%. They plan to build out 30 stores in the next 3 years. And Bloomingdale's comps were up 0.3%. They plan to build out 15 stores across outlets and smaller format. So people still liking and going to those luxury retailers.
I thought it was interesting, Brooke, and you touched on there sort of the commentary and color we got about how they were thinking about the consumer. CEO Tony Spring, right? He's talking. Yeah, Tony Spring was talking about, listen, strong job growth and wage growth, but to your point, he also talked about stubborn inflation, and it's a headwind for his customers.
Yeah, it absolutely is. And what's interesting is we're seeing these two different dynamics play out under one company. You have those luxury brands that seem to be doing somewhat well, definitely better than the everyday Macy's customer.
Yeah. Lowe's also reported. What can you tell us there? What was the takeaway?
Yeah, the company also beat earnings, but once again, low expectations there. So a similar saga. And they're also citing a cautious consumer there on the call. The CFO there said that consumers are digesting and adjusting to monetary tightening, and they're kind of remaining on the sidelines now. Similar to what we heard at Home Depot, that DIY, that everyday customers pulling back. Lowe's did see same-store sales fall 4.1%, and the DIY customer actually makes up a larger customer base for Lowe's than it does for Home Depot. It's about 75% of Lowe's shopper base. And so the pro business, on the other hand, think strength in roofing, concrete and block, drywall, installation. That business offset that decline in the DIY customer. And online sales also saw positive comp sales for Lowe's. They did announce that they are really investing in the DIY loyalty program. And they also expanded their same-day delivery with DoorDash. And they also have a partnership with Instacart. So they did see online sales do well for them.
The shares are down.
Shares are
or at least
down,
they were down
off of that cautious consumer right now.
Yeah, exactly. So it's interesting. I guess it's just all an expectations game, because in the case of Macy's, it was sort of similar in terms of what they're expecting and what they're seeing and the temperature from the customer. But Lowe's kind of saying the same thing and getting punished more for it. But I guess it's it's relative to expectations and what the stocks have done.
Yeah, what Lowe's shares, I should point out, down now about 2.5% as we make our way to the close. But really, Lowe's customer sort of says, we have all the capability. We're just waiting for that customer to be able to come back to the store, be able to have that extra cash in hand to lean back into that home renovation. He said that the customers are still looking for experiences over doing those DIY home reno projects, and also the housing market. That's really what they're waiting on. That to rebound as well.
I wonder too, Brooke, how much is like pandemic still hangover? I mean,
Oh,
how many
absolutely.
people, right, remodeled,
They did all that
right?
stuff
They did all
already.
that, right?
Yeah.
And now you can still sit on it.
Yeah, and a lot of people did buy new homes during the pandemic, and they really invested in those homes that they bought. So now, once again, as I just said, Lowe's really waiting on that customer, that new customer, to then buy a house and then have the money. You know, and thinking of interest rates, thinking about how much more customers are paying these days for housing. They just at the end of the day, even if they're getting that house, they simply don't have the money to put back into it.
Right. All right. Thanks a lot. Appreciate it, Brooke. Well, shares of Trump Media and Technology, that's another one that is trending. DJT, of course, is the ticker there. Shares are sinking after it reported net losses of nearly $330 million in the first earnings report since going public here. Their revenue fell from $1.12 million a year earlier to $770,500.
Yeah.
So that's not, I mean, to be clear, this thing doesn't really trade on whether it makes money or not.
No. The New York Times had a good piece, though, kind of looking at, I'm sorry, Julie, how sort of Trump's financial future is now kind of linked to this endeavor. Because we talked about this. When it debuted in March, it turned his stake into a $5 billion bonanza. But of course, as the Times notes, it's precarious because really, there's no products here beyond Truth Social, which right now still has a small audience and the revenue trends you're pointing out.
Right. Well, and he owns almost 2/3 of the outstanding shares of this thing, but there's the lockup period. So he can't sell shares until 6 months after that debut that you referred to. So are the shares lower than they are now? We'll see what happens. If other people are buying the shares because they believe in him, and then he starts selling when we get to that 6-month point, that's not going to be so, comfortable for other people holding them.
We'll wait and see.
Yeah.
Coming up, shares of First Solar, they're soaring today after getting price target raises from Piper Sandler and UBS. And check in on some of the top calls of the day when market domination returns.
Let's get to some calls of the day. We start with Piper Sandler and UBS, both raising their price targets on First Solar. Yesterday, we spoke to First Solar CEO Mark Widmer, and he told us about what has been driving the solar industry.
Look, I think it all started with the, Inflation Reduction Act, that was announced a couple of years ago now, almost 2 years ago now, that enabled kind of this first of a kind opportunity for this industry, a whole of industry approach that could now see across the balance of this decade.
And Widmer talked about the investments that his company is making in R&D this year. They're also going to be the beneficiary of $1 billion worth of tax-related subsidies as a result of the IRA. And that seems to be what's behind at least one of the calls here.
Yeah, it was interesting. So the team at UBS is saying basically AI-driven electricity demand is going to ramp, and that's good news in their opinion for this name. Take their target to 70. They reiterated buy. They talk about how AI uses about 10 times more electricity than traditional Google search. And they talk also about how big companies, Amazon, Microsoft, Meta, Google, have kind of committed here to purchasing renewable power equal to their consumption of electricity.
Right. This push, the subsidization, the incentives that are in place, in particular to have them sourcing that power from renewable sources. Kashi Harrison over at Piper Sandler raising his price target to $219 from $195 and pointed to some of the Inflation Reduction Act measures that will be helpful for the company. Something just quickly that I want to point out from the UBS note from John Wyndham is the numbers. He said he's estimating earnings per share will grow from $7.74 last year to $36.74 by 2027.
And sees gross margins expanding too.
Yeah, I mean it's a relatively long ramp, but that's a big jump.
You can see these investors piling, and just pull back that chart. Julie, stock is up about 30% now since early March. I mean, as your point, also seen as just one of the winners of these higher tariffs.
Yes, exactly.
Shares of XPeng, let's check that out. They're rallying today after the company reported better than expected first quarter earnings. So Chinese EV maker Julie, they reported it looks like a narrower than expected Q1 loss. Revenue jumped about 60%. That was better than estimated. Margins look like hang in there. They delivered about 22,000 vehicles. They're targeting 29 to 32,000 vehicles this quarter. Analysts had actually wanted to see something closer to 38,000, so a miss there, but investors boomed in.
Yeah, and they didn't do great last year. We've seen some challenges among some of these Chinese EV makers. Li Auto came out with disappointing numbers earlier in the week. XPeng does have partnerships with some other automakers like Volkswagen, for example, and it is talking about new products coming to market before the end of the year that will be in a pretty wide price range, so designed to appeal to a pretty broad swath of consumers. The question remains whether Chinese consumers are feeling spendy when it comes to these EV companies.
The stock is higher today. We should mention, though, this has been a slog. Yes. I mean, the stock was down about 40% this year through Monday's close. Here's what the team at Bernstein told their clients. Margin improvements encouraging, but they say more proof awaits on the core recovery. They stick with their market perform rating. In other words, they're on the sidelines.
Yeah. Well, let us stick with electric vehicles and talk about Tesla. Shares of that company rising after it provided an update on its long-awaited electric semi-truck project, or I should say semi-truck project. Here are the details as Yahoo Finance Prof. Subramanian. Semi for trucks, semi for conductors, I think.
I've heard both.
Okay, well, in any case, we're talking about tractor trailers is what I always called them.
Tractor. This is a weird term, a tractor trailer. I never understood the whole concept. But anyway, yes, update on the long-awaited semi-truck. Yes, the car that came out that was debuted in 2017 still is in the pilot testing of that vehicle right now. So basically, the project manager was speaking at the ACT Expo, or the Alternative Clean Transportation Expo, talking about how they're on track to deliver these by early 2026. There's a new facility they're building attached to Giga Nevada. When that gets fully ramped up, they'll be potentially producing 50,000 units a year, which was, I think, kind of more than what people thought they would be kind of produce for such a big vehicle. But anyway, early kind of specs here, the 500-mile range version, the long-range one, weigh around 23,000 pounds, and the 300-mile kind of intermediate length truck, range truck is 20,000 pounds. Sorry, a lot of numbers here. So yes, I think some bullishness there for that vehicle. tells us about how they have 3.5 million test miles done, both with PepsiCo, their original test partner, and also they're using the truck to deliver batteries from their battery facility in Nevada to the Fremont factory. So a lot going on there, trying to ramp up this truck. It's working. It seems to be pretty efficient. They're saying they can pull a full 82,000 pound load. They're beginning runs of 250 miles to 500 miles based on how the elevation changes, things like that. So pretty kind of efficient there for this long haul sort of truck.
Real quickly, when are we going to see these on the road?
2026 is when they say, early 2026, first real beyond production or beyond pilot spec models. So we'll see that, yeah.
We'll be looking for them. All right, thanks, Frost. Appreciate it. Well, coming up, the defense sector has underperformed the broader market so far this year, but things may be better than they seem. We will discuss in our investor playbook.
The U.S. facing a grim milestone when it comes to the federal budget. Our own Rick Newman is here to explain. Rick.
I watch these numbers pretty closely every month, guys. The Treasury puts out a monthly statement, and it looks like something is going to happen for the first time this year, which is that payments on the national debt, which is called net interest payments, that's what the government has to pay to borrow. It looks like that is going to be higher than defense spending this year for the first time. It's also going to be higher than Medicare spending. So just a couple of years ago, this was the 7th biggest category of money going out the door in Washington, D.C. Now it has risen to number 3. And we basically know why that is. Number one, the government's just borrowing incredibly large amounts of money. And second, the interest rate the government pays has been going up because interest rates overall have been going up. The government has to pay market rates when it borrows money. It pays those interest rates to consumers, us, investors, and we're getting more for our money these days. So this is an unsustainable problem like many other parts of the federal budget situation, but not surprisingly, nobody in Washington really wants to address it anytime soon.
Well, so Rick, what are the implications of that? I mean, you say it's an unsustainable problem. There's a lot of quote unquote unsustainable problems that have been going on for a long time. So they seem pretty sustainable. So like, you know, what are the implications of this? What happens as a result of this?
Well, I mean, we've started to see the process. I think it's going to be a slow process, but we've seen a couple of downgrades of the U.S. credit rating. That's one example. The first one came in 2011, and then not much else happened until last year when we saw a couple more downgrades. The thing that is going to force politicians to deal with the problem is going to be an adverse market reaction. It's going to be when investors and when financial markets just come to the conclusion that the the Treasury Department is issuing too much debt, and that there's increasing question about the creditworthiness of the United States, its ability to pay, and that is going to force interest rates higher. Now, we saw a few wobbles in the market for treasuries during a couple of auctions last year, and the Treasury Department changed some of the things about the way it ran those auctions, and it seemed to straighten things out. But that was, I mean, a lot of people think that was a warning sign. We saw interest rates going a little bit higher than markets would otherwise have driven them last fall. And that is what a debt crisis is going to look like. Now, the Treasury seems to have gotten that problem under control for now, but that was a hint of it. And when it happens big time, that is going to be the thing that forces the politicians in Washington to deal with it. Nobody knows when it's going to happen, but it is probably going to happen.
Well, we've seen it happen in other places that have been on similar paths. So, Rick, thank you very much. Appreciate it.
Bye, guys.
Simply put, geopolitical tensions are high amid the ongoing Russia-Ukraine war. Escalating conflict between Israel and Hamas have threatened to spill over in the Middle East. Yet against this backdrop, defense names have failed to see significant upside. The sector's underperformed the broader market this year, but there could be opportunities ahead. We're helping you navigate the big picture with the Yahoo Finance Playbook. And to discuss, we're joined by two senior analysts covering aerospace and defense, Ronald Epstein from Bank of America Securities and Jason Gursky from Citi. Guys, thank you so much for being here. It is a dense issue, but one that is important to sift through when we look at these particular stocks. Jason, I want to start with you, because if you look at the U.S. Department of Defense budget here, it's still going up and to the right, so to speak. It is still growing. Why have we not seen U.S. defense stocks benefit as much?
Well, it's all about expectations and what the budgets are going to look like going forward. And I think they look at a couple of things that have, given some pause to investors here of late. Part of that's the setup that you just had leading into this conversation here, right? The potential crowding out effect of higher interest costs. We've got choices here, right? At the federal government level, we can raise taxes. We can, decrease spending in other areas as interest costs become a greater percentage of the overall budget. Or we can reform ourselves, particularly on what's deemed to be the third rail of politics, which are the entitlement programs like Medicare, Medicaid, and Social Security. So that's one area. It's the crowding out effect. And then the second part of it is political dysfunction, and just watching what's going on in D.C., seeing elongated periods of time in which it takes to get a budget approved, seeing things like debt ceilings getting threatened, going over some sort of gigantic cliff, committing suicide kind of thing, and then budget caps, coming out the other side of these things that oftentimes, at least in the very near term, kind of ruin sentiment around defense spending, because suddenly investors are afraid that there are artificial spending caps put on defense spending. So those are the two things. It's the crowding out of interest expense, and fear around the political dysfunction in D.C.
Ron, let's bring you in here as well. Maybe we'll just start big picture, Ron. Broadly, when you look at your coverage universe, Ron, U.S. defense names, how bullish are you on the sector, Ron, in the kind of near to intermediate term here?
Yeah, I'm actually quite bullish on the sector. If you look at the defense stocks during presidential election years, or if you go back to 1980 anyway, and you were to look at, say, a basket of defense stocks, they tend to outperform during presidential election years, about 80% of the time. And when they do, they tend to outperform by a wide margin, almost over 1,000 basis points. And if you take out a couple of years that were just kind of massive years, it's still hundreds of basis points. And if you peel back the onion on that, during an election year, typically they outperform in the second half of the year, and the bulk of that happens in the third quarter, so no surprise around election time. So when I look at the underperformance of the sector relative to the broader market, and maybe even things like commercial aerospace in the first half of the year, I think the setup into the second half of the year is actually pretty good. And then when you look at the outlays from the U.S. Treasury, they're a good coincident indicator for the sector. They've been up and accelerating. That's good for the defense stocks. So yeah, my stance here, particularly kind of short term into the second half of the year, is actually quite bullish.
So it sounds like both of you see some scenario for upside here. Jason, in terms of the stocks that you think are perhaps best poised among the largest aerospace and defense companies, I know you're looking at Lockheed and General Dynamics. What is differentiating those two?
Yeah, the first thing I'd say out of the gate here is I am on board here with Ron's thesis that the back half of the year is going to be pretty good for defense stocks, because I think we are going to begin seeing the backlogs that have grown here, 15% over the last few years, begin to make their way through the revenue streams. And importantly, I expect margin expansion to become an investor narrative as we move into the second half of the year, because these companies are starting to roll off the pre-pandemic backlogs that they had, where they had to absorb inflationary costs, as well as supply chain bottlenecks that led to higher costs for them all over the last few years. Those contracts are rolling off, signing up new ones that better reflect the current cost environment. So we've got accelerating revenue and accelerating margins as we move into 25 and beyond. So I think that's going to be good. Now, as far as Lockheed is concerned, look, this one right now is kind of all about the F-35. That aircraft is not delivering today in light of some technical issues they're having with the software on that aircraft. That should work its way out here over the next 6 to 9 months. And I think investors will breathe a big sigh of relief when that happens. I think that's an identifiable catalyst for Lockheed in the second half of this year. And look, as far as GD is concerned, ship budgets have gone quite a bit higher here. We got a lot of work ahead of us. The supply chain bottlenecks that I just talked about are getting better. That'll benefit GD. And then these guys also own a bizjet manufacturer called Gulfstream that just introduced a new product. And I think we're likely to see accelerating revenue and margins in their aerospace segment as well. So here again, pretty constructive on both these names.
And Ron, another question I had for you, I'd be real curious to get your take on this, is how venture investors, Ron, have discovered defense tech startups and they've moved in. Mm-hmm. We had Anduril's Palmer Luckey on the show, and it's impressive what he and his team, the portfolio they've built out, Ron, in a short amount of time. How much competitive pressure do you think these kind of smaller, nimbler defense tech startups actually pose to just kind of the bigger, more established names you cover?
Yeah, I mean, they will potentially pose pressure one day. They're not there yet. However, they are gaining some share. I think a couple really notable things. There were a couple contracts that were just awarded by the U.S. Air Force recently. One was for the so-called Doomsday aircraft. Boeing was up against the Sierra Nevada Corporation. It's a privately held company, and Sierra beat Boeing. There's another one that was out for something called the CCA, the Collaborative Combat Aircraft. That was won by Anduril is one of the companies that won it, and General Atomics was. Anduril is one of the new kids on the block, and General Atomics is a privately held company. So you've seen some privately held companies and some startups gaining some share. Now, it's just small pieces of the larger industry, so we'll see where it all goes. But what these new companies are bringing to the DoD is, I think, a fresh approach to defense contracting, a focus on software, a focus on the interplay between software and hardware. That is to say, building hardware around software as opposed to stuffing software in hardware. And we'll see where it all goes. But if I were at one of the big contractors today, I most certainly would be looking at Anduril, Shield AI, among others, as a potential threat down the road.
Well, and sort of on a related point, Jason, do you think that these large defense contractors are doing enough internally to innovate, to keep up with some of these upstarts, or do you think we're going to see some of the startups being snapped up and being acquired by the public companies?
Yeah, probably more the latter, to be honest with you. I mean, they all have, corporate venture capital arms. They are, looking to partner with smaller companies, looking for technology plays. Just kind of like Cisco did back in the day, or some of these tech companies have done back in the day, right? They use M&A as their R&D budget. So I think this is very well could be the way that it plays out here in the defense world as well.
Ron, quickly here, I'm just interested to get your take on Rocket Lab. Rough start, Ron. It's at about 20% so far this year, but you say it's a buy, Ron.
I do. Yeah. I mean, there was a whole cohort of SPAC-funded space startups that many of them, were, how can I say, very, very early stage, weren't quite ready for prime time. Rocket Lab is the real deal, and Rocket Lab currently is working on a new rocket called the Neutron. They are going to, test fire the engine for that rocket called Archimedes in the second half of the year. And once they test fire that engine, and that's will bode very well for Neutron. Once Neutron goes into service, which is supposed to be sometime, say, in the middle of next year, that'll be a competitor to the Falcon 9. And we've seen how successful SpaceX has been with the Falcon 9. This will be another medium lift launch vehicle that will address that market. And there's plenty of launch, there's plenty of demand for launch in that segment of the market. So this is potentially a game changer for the company. So yeah, when I look at what Rocket Lab is doing, they're doing some really amazing, innovative things. We have a buy on them, and it's one of the smaller companies we follow that I think is quite interesting.
Guys, really good actionable stuff for viewers. Appreciate it. Ron and Jason, have a good one. We are wrapping up today's market domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
And at 4:30 Eastern Time, it's the latest edition of our new show, Asking for a Trend. Got you covered with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. But Market Domination Overtime, that's next.
That's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. So let's start with where the major averages ended up here. Slightly positive is where they ended up by and large. We had the Dow up just about 1/5 of 1%, near the highs of the session here. The S&P 500 up about 1/4%, as was the Nasdaq Composite. All of them drifting a little bit up to the highs of the session by the end of the day here. We continue to talk about the broadening of the rally in the market, but the S&P Equal Weight Index actually finished a little bit lower today, but we have been seeing it sort of catch up and outpace as of late. Maybe that's changing as our eyes turn to Nvidia. I don't know. But Jared's got a closer look at today's action. Hey, Jared.
It is that Nvidia drift that we were talking about yesterday. The stocks did just slowly creep up into the important announcements. Whether or not that's the case, I don't know. But we do have utilities behind me in the #1 slot today, up 0.9% on an otherwise pretty boring day in the indices. After that, we have consumer discretionary, that's XLY, then financials, staples, all those outperforming. Energy, the biggest laggard here, down a whopping 0.5%. And looking at the leaderboard, it's split too. On the upside, we have solar and cannabis. Those were the two biggest winners, and not by a large margin. And then to the downside, we have Chinese stocks. That's K-Web, internet stocks in particular, down 2%. Also, crypto now down a little bit. And let's just forward to that board. I thought we were just talking about all these crypto prices. Guess what? Crypto prices are recorded on a 24-hour basis. So even though over the last 2 days we are up 4.5%, 24 hours ago, we were a little bit higher, and the same for Ethereum. It's up 8%. An hour ago is up 22% or thereabouts. So that just accounts for some of the differences. It's one of measuring. But let's go through some of our heat maps here. Here is unprofitable tech, and you can see Tesla up 6.66% today. In Omen, maybe a positive one. We're not seeing a lot of bullish action in some of the other stocks. Shopify and DraftKings each down 3%. So is Roblox and Unity, it looks like. But here are those Chinese stocks that we were taking a look at. NetEase down 5%, JD down 4%, Baidu down 3%. If we take a look at the 1 month trailing, we're going to see a lot higher prices here, and that's as Chinese stocks have simply become wildly overbought. So not surprising to see a little bit of a pushback today. We can also take a look at the banking sector, and here we go. We got JP Morgan. If I can get my print here, JP Morgan up about 2% there. We do have Wells Fargo up 1% and Bank of America up 2%. I'm going to have to send it back to you guys. I've lost control of the Wi-Fi Interactive, but I'm sure you got things covered.
We do. Thanks, Jared. Appreciate it. And, as we see this higher close today, the S&P and the Nasdaq in particular actually closed at record highs because of this sort of slow push that we've been talking about, particularly in large cap tech. If you take a look at the Nasdaq 100 on the Wi-Fi Interactive, which I brought up here, Nvidia is creeping a little bit up, did creep a little bit up in today's session, up about 2/3 of 1%. Microsoft up 0.9 of 1%. Tesla, a real standout here. Jared was just talking about that, up 666 today. 6.66%. But basically, we do have, it's not as though there are fireworks in the market right now on an index level at all. Yeah. It's actually pretty quiet, but it's just sort of, I don't even know, would you call it a melt up? With the, maybe?
Melt up.
Sure, let's call it a melt up.
It was interesting, Kevin Mon, we were talking earlier in the show. I mean, really, we asked Kevin, all eyes on Nvidia.
Yeah.
Him and everybody else, where the bar is really high. I mean, earnings tomorrow after the bell, 90% move already this year. Sky high expectations.
How high is that bar? It's up 93% this year. And if you look at, say, a 5-year chart of this stock, I mean...
Back when we were talking about video games and crypto, that was Nvidia, right?
Yeah, that was exactly. So it's been pretty incredible. Let's also talk about another group where we've seen a pretty incredible move and an unexpected one. Investors are indeed waiting for Nvidia earnings after the closing bell tomorrow. Stocks move higher on that. The focus is on tech when it comes to AI, but there's another sort of corollary, surprising sector that has become an AI bet. We're talking about utilities. As we pointed out earlier, it's the best performing sector this year. Joining us now is Pavel Molchanov, Raymond James Managing Director, focusing on renewable energy and clean technology. Pavel, thank you so much for being here. Appreciate it.
Thanks for having me.
So this line that people are increasingly drawing between the power that's going to be needed for things like data centers and the growth of AI and utilities, I guess, first of all, just big picture, is this the correct conclusion that people should be drawing here? I mean, after all, utilities are a regulated industry. How much upside are they going to see?
Utilities have regulated prices. That is absolutely true. On the other hand, the amount of electricity, meaning the kilowatt hours that are used by the economy, that is ultimately up to the economy. So if data centers, for the first time in 20 years, create growth in overall U.S. power demand, that is a very good thing for utility companies across the board. So volumes of their sales go up, even though the price is fixed by state utility commissions.
So, Pavel, it's interesting because traditionally, if you thought of utilities, and you moved into them because you were hunkering into a defensive crouch. It was the same reason you went to Staples or healthcare. But now it's a lot of people perhaps moving in because they want exposure to that boom of interest in AI. So should we think of Pavel as it's both defense and offense?
Well, it's predominantly defense. Let's be honest. When we talk about power demand growing in the United States, it's a big deal because we have not seen U.S. electricity demand growing meaningfully for 20 years. That being said, the kind of growth we're looking at is, between 2 and 3% a year, right? So, we're not talking about double digits. 2 to 3%, that is a big change from virtually no growth since 2007, but it's still, not exactly tech sector kind of growth.
And there has been talk that the power companies that will do the best are those that perhaps are in areas, physical areas, where you have a lot of data centers. Is that how you see it playing out?
There's a lot of regional variability here, yes. So Virginia, Data Center Alley around Washington, D.C., Ohio, another big place, to some extent Texas. Not as much along the West Coast. Why? Because in California, power prices are very high, and therefore the economics of data centers are just not as attractive. So, it's predominantly going to be in places where electricity is cheaper. And, just to frame that, California, people pay, at the residential level, 30 cents for electricity. National average is half of that. It works a little bit differently in the commercial or enterprise market, but you get a sense of how different these price structures can be depending on the state.
Pavel, let's say you're a viewer, you're listening right now, you're very curious, you too would like to play the broader, grid modernization trend. One way to do it, Pavel, you say, is GE Vernova. How come? Why that name?
GE Vernova does everything for the grid: natural gas, nuclear, hydro, wind, and also all the infrastructure. So the transmission networks, the power storage, the software for utilities. This company does it all. And half of its revenue is recurring. So it's services in addition to the equipment itself.
Pavel, thank you so much for joining us today. I always appreciate the insight and the picks.
Thank you.
Stocks closing the day higher as investors are awaiting those highly anticipated earnings from Nvidia. Tech giant has gone from creating chips for gaming to becoming one of the world's leading AI chip companies. Let's take a closer look now at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say Nvidia is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market value is well over $1 trillion. Let's take a closer look at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments. Nvidia was founded on April 5, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, Nvidia launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, Nvidia went public via IPO at $12 per share. And in 2000, Microsoft chose Nvidia to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose Nvidia's hardware to power the PlayStation 3. In 2010, Nvidia became the graphics chip supplier for automaker Audi. And in 2015, the company launched its Nvidia Drive chip for powering driver assistance technologies. In 2016, Nvidia kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted Nvidia RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using Nvidia's Tesla P4 graphics cards for its Google Cloud platform. In 2022, Nvidia debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. And in May 2023, Nvidia eclipsed the $1 trillion market cap mark, joining the ranks of mega companies like Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading at over $700 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, Nvidia remains at the top of the tech industry.
Comcast revealing the price of its recently announced Stream Saver bundle, which includes Peacock, Netflix, and Apple TV+. Yahoo Finance's Alexander Canal here with the latest on The bundling landscape.
The bundling landscape, and our first clue to how much some of these bundles will cost, because we've had a lot of announcements recently when it comes to bundles. Now we know that the pricing of the Stream Saver will be $15 a month. Now, as you mentioned, Julie, this includes Peacock, Netflix, and Apple TV Plus. It is going to be the ad-supported versions for both Peacock and Netflix. It's going to be offered for Comcast broadband, internet, and TV subscribers in particular. So this is obviously a play to try and keep those subscribers, which has been on a steady decline. Customers can also access Netflix and Apple TV Plus subscriptions through Comcast's Now TV streaming platform. This is a new streaming platform they're trying to gain traction to. That includes Peacock and 40 other channels for $20 a month, but for an additional 10, you can secure access to the Netflix and Apple TV Plus platform. So obviously we're in a moment right now where a lot of these companies are facing increased competition. There's a lot of pressure to scale the services to make sure that you're not only attracting subscribers, but retaining those subscribers over the long term. And analysts have told me this is a big play to combat against churn, which is basically a practice of people signing up for a service and then immediately canceling it. So if you can create some sort of value among the bundle, then hopefully consumers will sign up and will continue to stay over the long term. So that is the big question here.
Yeah, it's so interesting because we talked about this. I mean, the strategy, I get it in in theory. I'm going to reduce churn. I'm going to increase engagement. But at the end of the day, is it really about the bundling, or you have to give me great content and you've got to invest in that? That's what keeps me engaged.
Yeah, and I think it's interesting to see which companies are partnering with whom they think is someone that could potentially offer that really solid content. I think the fact that you do have Netflix, which has consistently been called the winner of the streaming wars, with Peacock.
The king of streaming.
King of streaming. Yeah. I think that is a big play. But, you know, I think time will tell whether or not consumers are actually going to buy into all of this. It's certainly an interesting time to be a consumer because it's hard to know what content to watch where.
I can't keep track of the bundles.
It's crazy. And now with sports too. I mean, we have that upcoming sports joint venture streaming bundle with Warner Brothers Discovery, Fox, and Disney.
That one I'm interested in the price.
That pricing is going to be interesting. It's probably going to be closer to about $50 a month, but that's going to set a big standard when it comes to the other over-the-top sports streaming platforms. ESPN is coming out with its own exclusive over-the-top platform in 2025. Whatever its bundle with Warner Brothers Discovery and Fox is, whatever that is priced at, that should give us a good indication of what the ESPN OTT platform will be. But pricing is going to be a big factor here. They can't price it too high, but they also can't price it too cheap, or else you're not going to make money.
Yep. Allie, thank you. Appreciate it. Moving on, marketing budgets continue to decline, falling to a post-pandemic low of 7.7% this year. But what does that tell us really about corporate spending and the economy? Here to help us break down the overall advertising landscape is Double Verify CEO Mark Zagorski. Mark, it is always good to see you. And maybe, Mark, listen, I'm always interested to kind of start high level, get your kind of general take, Mark, on just the online ad market. How healthy and resilient is it right now, Mark? And what do you see ahead?
Yeah, the overall online ad market is in pretty good shape. I mean, you're seeing certain pockets really do well. One of which you just mentioned with your last guest, connected television. Connected television is growing substantially based on the fact that it's taking some dollars away from linear television for sure, but also pulling dollars from some traditional media publishers as well. You also have some growth areas like retail media networks, which are booming right now, which are folks like traditional retailers who now are using their data to extend their power to the advertising space, right? So you can target folks who are looking for certain products off those retailer sites. So overall, digital media spending is pretty healthy.
So I guess, Mark, how should people read your recent earnings then as a prism into this kind of spending? Because, your stock got smacked pretty hard following those numbers.
Yeah, we had some concentration challenges with a few big customers. But overall, most of our customer set across all the different verticals is relatively healthy. And we're especially seeing growth in areas like retail media networks, where we continue to grow over 40% last quarter. Social, which grew 50% for us last quarter. So you're thinking about social platforms like Meta, TikTok, YouTube continue to be strong. And growth outside the U.S. Last quarter, growth outside the U.S. Topped 40% as well. And for the first time, international growth or international spend was 30% of our measurement revenue. And so we are seeing, strong pockets of growth in certain areas. And I think, outside of that concentration that we had in a few big customers, we're having a solid year.
So that's interesting, Mark, just to kind of double tap on what Julie's talking about, because it did sound like you guys were projecting slower growth, but what it sounds like you're saying is, this isn't some, permanent secular downshift. This is just some uneven spending by some advertisers, and you expect that to kind of even out here?
Yeah, we called out a cluster of advertisers that were having some challenges earlier in the year. We think they'll eventually work through those, and that we see strength in many other pockets of our business. Like I mentioned, CTV continues to grow, retail media, social, and in particular, business outside of the U.S.
Something else that caught our eye is a recent report in the Wall Street Journal that talked about marketing budgets overall getting cut back, even as ad spending still seems to be okay. So I don't know what kind of visibility you have in your business as to sort of how the bigger marketing budgets are being deployed. Is that something that you kind of see reflected as well?
Yeah, we're seeing ad spend go to places that can be proven to work. So you see platforms and advertising entities that can show a closed loop where, hey, I showed an ad and I drove an ROI for actual performance. That is eating up dollars. So advertisers have no problem spending money or spending marketing budgets on stuff that works. And increasingly, digital works, and increasingly digital that has attribution attached to it. So stuff like retail media networks, people like Amazon, and platforms where you can show the exposure to engagement to actual sale. That's where the dollars are heading. So I would agree that marketing budgets may be a little tight, but advertising budgets that can prove lift, that can prove performance, I think are always going to attract dollars. And increasingly, there's great tools out there to show that can happen.
Mark, you got a big event coming up here, the Olympics kicking off in about roughly 60 days. Mark, what does that mean for the ad industry? What kind of tailwind is that?
Yeah, I think you've got a couple big events coming up. You've got Olympics, which obviously drive a lot of eyeballs, not just to linear TV anymore, but because of time shifting and in the way that the Olympics are being displayed. There's a lot of digital spend that goes there as well. So dollars follow eyeballs. Eyeballs are going to be watching the Olympics on multiple platforms. So I think that will drive new spend. But you also have elections coming up, right? And elections create lots of engagement. It creates some good engagement, some challenging engagement, but it creates engagement. And that drives dollars as well. So I think we're going to have a multitude of different tailwinds starting to hit the ad space over the next several quarters.
And talk to us about the Netflix tailwind in a little more detail. You were one of the companies that was named as a partner as they forge ahead with their ad-supported strategy. What is that going to mean for you guys?
Yeah, so we've been working with Netflix since their launch of the ad-supported tier back in October of 2022. And, that was, if you think about where they launched a year ago, they had about 5 million ad-supported subscribers. Fast forward to today, you're looking at 40 million, which I think is much faster growth than I think people expected. That has something to be said with what they did with password cracking down and starting to tighten up who could have access. Which I think drove those numbers. But ultimately, we think that CTV, particularly for Double Verify, is going to be a growth driver for us in the future. We mentioned recently we just did an attention study with Netflix. And one thing that's starting to happen with the CTV streamers is that they're starting to employ the same types of tactics that we saw with digital media, which is let's lean into data. The upfronts were all about data, what we can tell you about our customers, what we can tell you about what they engage with. And in this case with Netflix, we shared data with them and worked with data with them around how attentive or how much attention Netflix programming was driving. And I think you're going to see more and more of this, as the CTV streaming wars continue to heat up, particularly the ad-supported CTV streaming wars.
All right, as they heat up, Mark, we're going to have you back on to explain it for us. Thanks so much for joining the show.
Absolutely. Thanks for having me.
Time now for To Watch, Wednesday, May 22nd. We start off on the earnings front, of course. A make or break day for the market. Nvidia earnings are out tomorrow after the closing bell. Tech giant is the last of the Magnificent Seven to report this season. Nvidia stock has been on a tear over the last year, rising over 200% and closed at a record high today. Analysts expecting the company to report earnings of $5.65 per share on revenue of nearly $25 billion. That would be a 400% and 200% gain, respectively, from the same time a year ago.
Is it worth talking about anything else? Of course. Let's talk about the Federal Reserve because that's the other big event. The Fed releasing its minutes from the May FOMC meeting in the afternoon. We'll get more perspective into Fed officials' thinking around monetary policy as we look ahead toward the central bank's next meeting in June.
And finally, we're going to be getting new data for existing home sales in the month of April. In the morning, economists forecast that number to go up, this coming after last month's drop as high interest rates continue to pressure home buyers.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's our new show, Asking for a Trend. I've got you covered for the next half hour, the latest and greatest market-moving stories, so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Yahoo Finance's brand new show, Asking for a Trend. I'm Josh Lipton, live from our NYC headquarters for the next half hour. We're going to break down the trends of today that'll move stocks tomorrow. Now, there's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The consumer showing some signs of cracking here. Macy's is the latest retailer to call out financial pressure weighing on shoppers as they are being more thoughtful about discretionary purchases. Plus, closed for business. Red Lobster files for Chapter 11 bankruptcy as the number of companies seeking protection trends above average year to date. So which names are next? We're going to be taking a closer look. And of course, it's Nvidia earnings eve. The chip maker closing today at a new record high and expected to yet again blow past expectations in its results tomorrow after the bell. But how much further will the stock climb? We're going to check that out. Yes, expectations for Nvidia's latest report, they are sky high, and the tech giant even closed today at an all-time record. But what does it all mean for the S&P 500? Let's take a look at our chart of the day. Bloomberg anticipating the tech giant is going to add nearly 2.5% of EPS growth to the first quarter of the year. And Yahoo Finance's Julie Hyman is standing by with a deeper dive ahead of Nvidia's highly anticipated earnings report. Julie.
We can't stop talking about it, but this chart helps explain why, Josh. Why is Nvidia so important, not just for itself, but for the broader market? And indeed, this is an estimates gathered by Bloomberg. So we're looking at averages here. For the first quarter, the estimate is that Nvidia alone added 2.4 percentage points to earnings per share growth for the S&P 500. And if you look at the out quarters in the estimates as well, you're looking at it alone accounting for at least a percentage point of earnings per share growth for the S&P 500, even as far as in the fourth quarter when it's looking like, a little bit smaller at that point as the growth gets a little bit smaller. But nonetheless, as we know, there is an incredible ripple effect here because of the demand for generative AI, the chips to power it that Nvidia makes, the chips and software, by the way, and then the sort of ecosystem that has grown up around Nvidia. As we talked about in the last hour, then you also have utility companies that are powering the data centers that suck up a lot of energy. So there is this big ripple effect, but this chart illustrates that even Nvidia alone accounts for a lot of the earnings growth that we are going to see in the S&P 500 this year.
So here's the question, Julie Hyman. What is ahead? I mean, do analysts expect the growth to continue here?
Well, continue with perhaps some diminishing returns. That's what's interesting. So if you look at the earnings per share growth that the company has seen over the past several years, here's a chart here going back 5 years of the company's earnings per share. And you can see there has been an explosion last year around this time when there was really this ramp up in demand for generative AI and for the GPUs that NVIDIA makes to power the training of all of these large language models. So that's what's been going on here. The two sort of lighter color bars you see there are the estimates for the next 2 quarters, or this current quarter that's about to report and the following quarter. Well, what's interesting is the sort of diminishing returns. In other words, as the numbers have gotten bigger, it's harder, these year-over-year comparisons. Let me show you what I mean here on the next graphic, because while analysts are looking for 418% in earnings per share growth in the quarter that we're going to get tomorrow after the close, the first quarter of fiscal 2026 looks like only 29% growth, and then actually a drop in the year after that. Couple of things happening here. By that time, perhaps we'll have seen more of these large language models actually be completed. Yes, then they'll be working, they'll be doing the inference. So there's some questions about how much demand there will be for GPUs, but also it's presumed that there will be more competition in this market, that both the other chip companies will have developed their alternatives, but also the so-called hyperscalers, the companies that control the cloud or that run the cloud, the Amazons of the world, will also have developed their own chips. So a little bit more uncertainty the farther out we get, as is natural. But it'll be interesting to see if they do even manage to keep up a triple or double-digit pace of growth going out to the next few years.
All right, Julie Hyman charting it all for us. Thank you, Julie. Appreciate it. More than 200%. That's how much NVIDIA shares have climbed since May of last year. And if history is any indication, those gains are just getting started. Let's discuss with Dan Niles, founder and portfolio manager at Niles Investment Management. Dan, it is great to see you on the show because you are, Dan, perfect guy to talk about this. So Nvidia, Dan, I'm hard-pressed to think of a name that's more loved on the street. About 90% of financial analysts, Dan, who cover Nvidia, tell me I should be buying the stock. The stock's gone up about 90% already this year. These are some sky-high expectations heading into this print, Dan. What are we going to hear tomorrow after the bell? What do you think the response is going to be?
Well, I think you have two things going on. As you said, expectations are sky-high. And that's the biggest problem. Everybody knows it's a beat and raise. Everybody is expecting upside to the numbers that are going to be reported relative to analyst expectations. They're expecting forward numbers to go up a lot. That's the negative. The positive is valuation in the sense that NVIDIA's forward 12-month PE is 15% below its 5-year average. And so that's the other side of this equation. And if you think about the prior quarter, expectations were sky high going into that as well, and the stock still rallied about 16% after the print. Today was interesting in that you got a headline that I would have thought would have knocked the stock down, which was Amazon Web Services confirming through a spokesperson that they were taking some of the orders they had for the current generation of chips and moving those to the next generation of chips coming out called Blackwell, which comes out later this year. I would have guessed that would have knocked the stock down, but the stock actually closed at an all-time record high. The intraday high is back in March earlier this year, but it closed at an all-time record high. So that's a good sign that hopefully people are expecting a slowing in terms of sequential growth in the near term, and they're expecting some of this order movement as the newer chips come out. So we'll have to wait and see what happens tomorrow. My assumption is that given how it reacted to the Amazon Web Services news today, the stock will rally a little bit off of this, given it's at an all-time record high and expectations are high, being bounced by the low valuation.
So that's interesting. I just want to pull on that for a second because I've heard that from some analysts. And listen, these are fans of NVIDIA, but they're talking about just the point you brought up, that, listen, NVIDIA does have this new GPU platform, Blackwell. It's coming in the fall. The question has been, to your point, do NVIDIA customers delay or cancel because, hey, they're waiting for the latest and greatest to come? Your point is maybe you do expect to hear about that tomorrow?
Well, it's more nuanced than that. What I would say is that I expect some period of digestion. My belief is that customers in general, and maybe Amazon's big enough to get away with this, but customers in general want to get the new Blackwell chips. So they don't want to cancel the current chips orders that they have, because that's going to kick them to the back of the bus for the new chips coming out that are going to be 2.5 times more powerful, but only cost you 20 to 30% more. So my belief is that you really have a problem with digestion when Blackwell ships later this year, and then the quarter after that is when you run into a problem. And if you go back to Cisco, and we haven't kind of gotten to that, but if you go back to the analogies of the internet bubble build out, that ramp over 5 years wasn't linear. Cisco had several corrections that were pretty ferocious during that period of time. The stock was down 26% in late 1995. It was down 38% within 1997 at one point, and it was down 34% within 1998 for a period of time. It didn't stop the stock from going up 4,000% from the end of 94, which is when Netscape Navigator came out, which was the first internet browser, to its ultimate peak for Cisco's stock when it was the most valuable company in the world in March of 2000. So that's the analogy I would draw with NVIDIA, is expect a lot more volatility, but we're only 5 quarters into this AI build out. The internet build out took over 5 years, and I think we have a lot more room to run in the AI build out.
Let me get you out of here on this, Dan. When you talk to your clients and they say, Dan, what worries you about NVIDIA? What are the big risks? What do you tell them?
Well, I mean, the big risks is the ones that people know. The largest hyperscalers, they're all trying to design their own chips. So they're all trying to design their own silicon. In addition, NVIDIA's real secret sauce, if you will, is not the chips. It's the software called CUDA. And they've been working on that for, I want to say, at least a decade. And that's really locked people into their silicon, which makes it very hard to get off. But everybody's trying to develop an alternative to CUDA that's open source. But that's going to take an awful lot of long time to get people to want to go figure that out when the volume is on the Nvidia chips. So those are the risks. And the big one is what we talked about with Cisco, or I mentioned about Cisco just a minute ago, which is you're going to go through these ferocious declines. Everybody's going to say, oh my God, it's over. And then the stock will take off again, and you're not going to know until you get through it. And so that's the balancing act you're going to have to go through. But the good news is, unlike Cisco, we talked about Nvidia trading 15% below its 5-year average, and its multiple for this calendar year is 40 times, which will go down as soon as they report tomorrow because the numbers are going to go up so much. Cisco's PE compared to that 40 times for Nvidia peaked out at 135 times for 60% growth. Nvidia is growing 100%. So this stock's not overvalued by any stretch of the imagination. And in fact, you could say it's undervalued by a lot relative to its growth rate. And so that's something to keep in mind.
All right, valuation still looks supportive. Dan, thank you for joining us today. Got a big earnings print after the bell tomorrow. We're going to be watching. I know you will too. Thanks, Dan.
Thank you, Josh.
Corporate bankruptcies are happening at higher than usual levels this year. Red Lobster is the latest chain to file, but it has problems beyond bottomless shrimp. We're going to be taking a closer look at what's behind the trend. It's coming up next. U.S. bankruptcy filings happening at a higher than usual clip so far this year. Factors behind the trend extend far beyond Red Lobster and unlimited shrimp. Rapid Ratings helps assess and analyze the financial stability of companies. Chairman and CEO James Geller joins me now. James, great to see you.
Good to see you, Josh.
So maybe we'll start right there. Your point, James, is you look at the data and you say, listen, there is some increasing risk to companies. We need to think about more bankruptcies potentially on the way. What are the reasons for that, James?
Well, at Rapid Ratings, we're looking at public and private companies around the world. So we're seeing the trends in which companies are doing better relative to each other. But we perform ratings on all of these companies and do that for institutional investors, but also do it for companies managing the businesses that they work with, their suppliers, their customers, and so forth. So our lens is looking at a whole variety of different kinds of companies. And absolutely, the trend right now is towards more bankruptcies. In 2023, we had 72% more Chapter 11 filings than we had in the prior year. In Q1 of 24, we had 43% more Chapter 11 filings than we had in Q1 of 23. And April, in Q2, April has been the highest incidence of Chapter 11 filings in a year. So the trend is for more of them, and there are a whole variety of reasons for this, not the least of which is that we're coming off of an extended period of time where capital was incredibly cheap, very easy to get for companies of all credit qualities. Low interest rates until rates started to rise in the last couple of years. And then with the pandemic, we had PPP funding and other means of injecting liquidity into the system that really bailed out a lot of companies. So companies like Red Lobster were deteriorating from an operational perspective, but had a longer lifeline or a fuse life because they still had capital and liquidity left. As that burns down, if operations don't improve, they can't continue.
Is there a kind of profile, James, of a company that's most at risk?
Well, you know, companies that have leveraged up over the past 5 years are the ones that are more at risk because they ultimately have to either repay or refinance. Companies that have borrowed principally from banks or have been living off of investment from private credit are in a different bucket than companies that have access to the bond market, and that's because they are borrowing at floating rates. And with floating rates from banks and a lot of private credit, they're paying a lot more for that debt than when they put it on. So for a lot of companies, they didn't anticipate rates this high for this long, and they're paying for it now.
Are you, James, most of the bankruptcies you're seeing, is it smaller to medium-sized companies?
Well, it's a range. You certainly get the ones like the Red Lobsters or the Bed Bath & Beyonds, these sort of higher profile names. And that, I think, is good in the sense that it has members of the broad market recognizing that this is happening. But there are many more happening beneath the surface that people really aren't as familiar with. Companies are not as familiar with, companies that don't get the same kind of coverage, private companies, middle market companies. The Chapter 11 filings last year happened at a 9 times greater likelihood, 9 times greater incidence for private companies than public companies.
Are there certain industries, James, where you're seeing a higher rate than others?
Well, I mean, we're seeing certainly retail, certainly the entertainment industries. We see problems in autos, problems in aerospace and defense. And when you think about the smaller private companies or the smaller public companies in the middle market, these are ones that are upstream from the large Fortune 500 companies. So the upstream meaning they are the suppliers to them, or they are the suppliers to the suppliers. And as you go up that stream, you get smaller companies, you get more private companies, you get companies that have less access to capital, companies that have had operational deterioration, but have been surviving on this liquidity. And again, as that liquidity begins to dry up, it's harder and harder for those companies to continue to exist. And any place you've seen disruption in the broader markets for industries like entertainment, like food and beverage, like autos, things that got very impacted by COVID, have been impacted by consumer spending changes over the last few years, have been interrupted by various supply chain problems, those that require more international shipping. All of these have been under more stress. And what we see in our ratings is our core health score, which looks out longer term, 2 to 3 years, at the fundamental strength of a company. We see that deteriorating more and more. While the financial health rating, which looks out 1 year, both on 100-point scales, we're seeing the financial health ratings of companies beginning to come down at a faster pace. And when both of those are coming down, the companies are going to have a harder time refinancing.
Interesting. James, thanks so much for being on the show today. Appreciate it.
Absolutely, Josh. Thanks.
Moving on, a record day for the S&P 500 and the Nasdaq, and Nvidia just ahead of earnings. Josh Schaefer is here with the trading takeaways. Joshua.
Josh, it's all about AI this week. We can't talk anything without talking AI. And specifically today, looking at some of the movers in the market with utilities leading. We've been talking a lot about how AI and utilities have been linked recently. Also AI and energy. So when you take a look at the top performing sectors in the S&P 500 this year, 2 of those are utilities and energy. They've been outperforming the S&P 500. And one thing that's been interesting to look at when you take a look at that, Josh, is sort of how companies are starting to talk about AI more. So when you look at earnings calls here, this was interesting, highlighted by Goldman Sachs, energy companies mentioning AI.
Sprinkle a little AI on everything, Josh.
This is the fourth quarter. Less than 20% of companies are talking about AI. Fast forward to the first quarter of earnings, which is the quarter we just went through. Over 2/3 of companies talking about AI. So people have been talking about AI sort of being an energy trade, right? How are you going to power these GPUs? They take a lot of power. Well, energy companies are saying, yes, that's going to benefit us. Also, people believe it's going to benefit companies in the utility sector. So this is something I'm watching headed into tomorrow's NVIDIA earnings report. When you sort of think about, okay, NVIDIA is going to talk a lot about AI demand for their AI chips, right? But when they talk about that demand, what does that mean for sort of the broader rally that we've seen in other sectors? And I guess in some ways, are other sectors also going to move the same way that chips usually move with NVIDIA and big tech moves with NVIDIA after these earnings? Are we going to start to see other pockets of the market that have been a hot AI trade also kind of trade off that trend a little bit
So
after earnings
your
tomorrow?
point, Josh, is let's say NVIDIA reports on the conference call tomorrow. CEO Jensen Huang sounds very bullish about the quarter's ahead. Does that have kind of a positive ripple effect for some energy names, utilities, right?
Yeah, at some point, if they're going to sell, if they think they're going to keep selling more and more GPUs, right? Well, that means more and more power. I mean, I don't know what specific companies, and we could have strategists on that can debate that with us, right? What companies are going to be powering that? But at some point, the power has to come from somewhere. Morgan Stanley was out saying that these GPUs take 50x the amount of power that other GPUs used to take. So a massive amount of power being taken in for these new GPUs.
All right, let's go to the next Schaefer takeaway.
Our other takeaway is just simply NVIDIA's make or break moment. And I think when you look at markets today, we were sort of wondering where the catalyst was for the markets. It was a little bit of just kind of a drift.
Trying to find some direction.
It feels like it's like a CPI week, right? Like we're going to have an inflation print tomorrow or jobs Friday, a labor report on Friday, but it's NVIDIA's earnings. Like that is the moment this week. You take a look at options volatility headed into this and sort of what they're pricing in. It's pricing in an 8% move for NVIDIA after earnings. Most interesting to me out of that was how inaccurate that has been over the last couple quarters. It's always pricing in a pretty sizable move. We haven't always seen that with NVIDIA.
So not a great predictor.
It's not a great predictor, and I think that gets to sort of this AI trade of it's hard to understand kind of where it's going to go next, and also when investors have had enough. NVIDIA closed at a record high today. It wouldn't be abnormal for a stock to close at a record high, have very solid earnings, maybe even raise guidance, but still the stock doesn't go up because, again, it's already at its highest level ever.
90% already this year.
Yeah, it doesn't go up automatically, right? And then we take a look at our third takeaway, something a little different. Ethereum. Ethereum ETF optimism, Josh. So this is optimism around potential SEC approval. And I found this chart interesting. So Bitcoin, obviously, ETFs were approved earlier this year. When you take a look at January, Bitcoin actually went down a little bit at first on this news, but it's had a very solid rally. Bitcoin's in purple here since then, and you've heard a lot of positives about the inflows these ETFs have seen. And I think it was interesting to me to sort of take in crypto essentially moving on real news today. So when you look at the light blue line that's right next to me here, look at this massive jump. Ethereum was lagging Bitcoin on the year by 20% going into today, and it just rallied by 20% in the day. So a massive move for Ethereum. And if you're wondering what the basically what's it worth to have ETFs approved?
Yeah, look
Market
at that.
says it's worth about this much. Not a bad day.
Well, they know SEC's Gary Gensler, he didn't want that spot Bitcoin ETF. It took a lawsuit, right, man? So is it going to take a lawsuit to get your spot Ethereum ETF?
And if it does, it would take quite a long time, right?
Yeah.
So the market kind of aggressively pricing something in off one day and a little bit of rumors.
All right, Joshua, thank you. Coming up, we're checking in on some of the top trending tickers that are moving after hours. Stay tuned. More asking for a trend on the other side. Let's take a look at some tickers that are trending after hours here. Shares of Urban Outfitters, they're soaring after beating earnings estimates on the top and bottom lines. Net sales for the first quarter grew nearly 8% year over year, hitting a record of $1.2 billion, beating the $1.18 billion consensus estimate. Looking ahead to the next quarter, CEO Richard Haynes says customer demand remains robust for our spring and summer fashion, which bodes well for continued sales growth in Q2. And in housing, shares of Toll Brothers rising on earnings. The home builder raising deliveries guidance for the full year, now expecting between 10,400 and 10,800 deliveries this year. Toll Brothers' fiscal second quarter results also beating estimates on the top and bottom lines. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.